Hi, welcome to this video today, which is all about Forex stop losses. What I want to do in this video is give some tips and rules in terms of not only placing your stop losses to give you good protection, keep you outside of the noise, but also how to manage your stop losses as trends run into profit. Now, in terms of keeping losses small, we all know that's wise investment wisdom. We've got to run our profits as well, so managing stop losses is very important, so we don't get bumped out the trade too early. If we've got a profitable one, we can run it. Now, in terms of most traders, they tend to be more focused on their entries than their stops. Stops are kind of an afterthought. You need a specific strategy, and the strategy I'm going to outline will basically help you smooth your equity curve, keep the losses relatively small, and over time, your account will grow. Now, in terms of the rules, they're all pretty easy to understand. I'm going to go through the logic of them, and the rules are easy to implement. So what we're going to do is we're going to go to a storyboard and discuss them all in more detail. All right, just going to give you 8 key points in relation to a Forex stop loss strategy here. If you want to learn more about money management and all aspects of Forex trading, you can actually join our free mailing list on the link beneath this video, and also check out our course which you can try risk-free for 3 months. Now, in terms of point number 1, it's place your stop outside of the noise of the market. Now, for this you have to look at the daily range and take into account the volatility of the pair. Now, in terms of what I mean by this is, let's say you've got average movements in a day of around 100 pips. Your stop loss is going to be more than 100 pips. Okay, now in terms of these tips I'm giving here, I'm not giving tips for day traders or scalpers. That's just a great way to lose money, just trading in the noise of the market. This is for traders who are trading sensibly. They're trading off the daily charts. Okay, it is a major error. Many traders do come in and place stops of 50 pips or 30 pips or whatever, hope the trade is going to run in their direction. If you try that too often, it's not going to work. You've got to use sensible stop loss levels. And on daily charts, I always think it's probably 100, 150 pips, sometimes more. It depends on the volatility of the pair. Now, a major error that beginners make is they look for the obvious level to place their stop, and then they place it just behind the obvious level of support or resistance. What you've got to think about is if it's obvious to you, it's probably obvious to everyone else. So stops are going to cluster at the first level, of support or resistance. Institutions know this. They'll run the price towards the stop, take out the cluster, and then the price will rebound the other way. I'm sure many traders have just been picked off on stop, and then the price is immediately reversed the other way. They think their broker did it. No, it's big institutions who make it their business to hunt retail stops. So the first level, the obvious level of support or resistance, don't put your stop behind it. You place your stop, in my view, behind the next level back. Okay, so you avoid getting hit in a stop cluster. Okay, now in terms of when you're placing your stop, you look for the second level back, but what you want to do is also take round numbers into consideration. Okay, so let's say the second level of support is let's say 130 in the British pound, for example. Do not place your stop on the round number. It's amazing how many traders do. I've been a broker and I've seen traders just place their stop exactly on the round number within a couple of pips of it. Total mistake, because round numbers, they're very important in Forex trading. They're psychological levels. They're easy to remember, of course, and institutions know that retail traders will put their stop on a round number, so they'll always try and run the price up to grab those stops. Okay, my kind of rule of trading in terms of round numbers is, if I'm doing a stop, it's normally at least 30 pips back from the round number. So basically I'm stopping the institutions most of the time from coming through and taking my stop. They'll normally force it through 15, 20 pips or something like that, in my experience. So I want to be out the way and again avoid getting hit in a stop cluster. Okay. Now, in terms of point number 5, this is the reason why a lot of traders actually put their stops too close. Okay. What they do is they decide their trade size, and let's say they're really confident about a trade. They want to do a big one, so they do the big trade, and then they think, it's quite big, I can't afford to lose too much, I better put my stop at X level. Okay, and they put it too close. Okay, what you should do is determine the stop before deciding the trade size. So, for example, if you've got a pair not too volatile, you need to risk 100 pips to stop, that trade size could be double that of a more volatile pair that you have to risk 200 pips to stop. Okay, so what you're doing effectively is you're adjusting the trade size to the volatility of the pair and how many pips you need to risk. That will stop you putting your stop too close. Okay, now in terms of trailing stops, don't do it too quickly. A lot of traders want to do it too quickly. Okay, so as soon as they move into profit, they get excited, a little bit of profit, they don't want to give that profit back. So what they're going to do is they're going to move the stop to break even as quickly as they possibly can. That is totally dumb. Why? Because if you're confident about the trade, just if you move your stop to break even, sure, you won't lose any money, but you could miss a really good profit opportunity. Traders who move their stops to break even, just for the sake of it, never make any big money. They're just so frightened of losing. Okay, they want to come out at even, and then they say they're playing with the market's money, which is the most ridiculous thing out. They've just increased their chances of coming out with nothing rather than something. Okay. Also, in trailing stops, never use a set number of pips. I'll trail it up just like 50 pips behind once I've got some profit or whatever. That is dumb. You've got to look at the pair and the levels. There's no way around it. You can't reduce stop losses in terms of trailing them to mathematics. Okay, if you're trailing the stop, you keep going behind the second level. So you wait until the trade moves in your favor, and when it's moved up enough that you can move your stop behind the second level of support or resistance, you do it. Okay, so you don't want to trail your stop too quickly. Okay, now in terms of point number 7, have an initial objective. Bank 50%, the other 50% run. What I mean by that is to always do 2 trades. Okay, you want, or most traders want, to really catch big trends and hold them, but it's very difficult to do. Okay, because you don't want to give back too much profit, and once your trade becomes a big profit, the temptation to move the stop too close, etc., comes into play. So what I would do is I'd have an initial objective, bank 50% of my trade. I've reduced my exposure, put money in the bank. That makes me feel good. Okay, I can then let the other 50% run with a sensible stop still behind the second level. I'm a great fan of stopping myself out of 50% of my trade, and I'll do it frequently because it smooths your equity curve. You're putting money in the bank, it makes it easier psychologically to stay with the trade. Now, very often when I'm trading, I might think, this could be a really big trend, but there's a kind of first level I've got in mind to get to. In the majors, it's normally about, at this moment in time, about 150 pips, and I'm looking for run-ons if I've got my analysis correct. So as soon as I've hit first target, 150 will go in the bank, let the other 50% run. I mean, it's not a hard and fast rule, but that is normally what I would do. Okay, always be banking partial profits. Okay, if the trade runs on, you're not going to get the best that you could have if you left everything in, but psychologically you'll catch more big trends because you bank money. okay, or more money from big trends because you bank money. Now, in terms of understand the concept of working equity, a lot of traders, they'll get into a trade, it looks good when they enter it, it moves, it stalls, it does nothing. They sit in the trade just waiting for either their stop to be hit or their target to be hit. You don't want to do that. If a trade doesn't do what you want, if you've got a small profit or maybe a small loss, and you see something better elsewhere, like a trade that could potentially move, it's on the verge of a breakout or whatever it is, or a trend in motion, shut the trade down you've got. It doesn't matter if you take a small loss, okay? You want your equity working. So you want to be in pairs that are moving fast or have the potential to move fast, i.e. there's volatility there. There's no point being stuck in a dead market. Now, they're the kind of salient points of my Forex stop loss strategy. There are more things that I take into consideration, okay, which I'll do a further video on. But like I said, you can join our mailing list and we'll send you more details on the concepts in this video and all aspects of Forex trading. So that is the video for today. Hope you found it useful. Thank you very much for watching me as usual. Take care. Have a good day.